I woke up at 5 a.m. Tokyo time to my phone ringing with a number I didn't recognize. And when I answered, a Japanese dealer I'd met once at a precious metals conference spoke in broken English with unmistakable urgency. "You need to see this. Come to Ginza now. Bring cash. What you think you know about silver prices is completely wrong." 2 hours later, I was standing in his shop watching wealthy Japanese businessmen paying $130 per ounce for physical silver bars while my trading app showed New York COMEX silver at $71. Same metal, same day, same planet, 83% price difference. I watched this with my own eyes, verified the transactions, checked the purity stamps, confirmed the weights. New York says 71. Tokyo is paying 130. One of these prices is real, and one is a complete illusion designed to hide the greatest market manipulation in modern financial history. Let me explain how I ended up in Tokyo, because this story starts 3 weeks ago, when I noticed something bizarre in global silver price data that made absolutely no sense. I track precious metals markets obsessively, monitoring prices across multiple exchanges, comparing physical dealer premiums, analyzing arbitrage opportunities. And I started seeing a pattern that violated every principle of efficient markets. Physical silver prices in Asian markets were diverging from COMEX paper prices at rates I'd never witnessed before. Not the usual $2 or $3 premium. Not even the $10 to $15 premiums we saw during supply crunches. We're talking about gaps of $40, $50, $60 between what COMEX said silver was worth and what Asian buyers were actually paying for physical metal. I made a chart tracking this divergence over 90 days, and the graph looks like a canyon opening up. 2 lines that used to move together now splitting apart like tectonic plates before an earthquake. So I bought a ticket to Tokyo, then planned stops in Hong Kong and Singapore. Because I needed to see this with my own eyes and talk to people who are actually buying and selling physical silver, rather than trading paper contracts on screens. My first morning in Tokyo, I visited 6 different precious metals dealers in the Ginza district, the financial heart of the city where serious money changes hands. Every single dealer told me the same story with slight variations but consistent core facts. Physical silver is almost impossible to source. Delivery times have extended from days to months. And customers are willing to pay massive premiums over COMEX spot price because they understand that COMEX prices are fiction disconnected from physical market reality. Tanaka Precious Metals, one of Japan's oldest and most respected dealers, had a digital display board showing their buy and sell prices. 1 kilogram silver bars, which is 32.15 troy ounces, were offered at 4,180,000 yen. I did the conversion math 3 times because I couldn't believe it. At current exchange rates, that's $130 per ounce. Meanwhile, COMEX spot silver was trading at $71.40. I interviewed Hiroshi Nakamura, a senior metals trader who's worked in Tokyo markets for 37 years, and his explanation was delivered with the patient frustration of someone who's been trying to warn people about this divergence for months. "The New York price is not real," he told me plainly in excellent English, gesturing at screens showing COMEX quotes. "It's a paper price created by banks trading contracts they have no intention of delivering. In Tokyo, in Hong Kong, in Mumbai, in Dubai, we trade physical metal, real bars that must be delivered, verified, stored. The physical market and the paper market have completely separated. Americans looking at COMEX quotes think silver is cheap at $71. Asians looking at actual metal supply know the real price is over $100 and climbing." He showed me order books from the Tokyo Commodity Exchange going back 6 months, and the premium over COMEX had grown from $12 in September to $43 today. That's not market noise. That's a structural break. The graph I created showing this price divergence is genuinely shocking in its implications. I'm looking at it now. A blue line representing COMEX spot price, relatively stable, moving between $68 and $74 over the last 3 months with normal volatility. And a red line representing actual transaction prices in Tokyo physical markets, starting at $83 3 months ago, and climbing steadily to $130 today. The gap between these lines has grown from $15 to $59. $59? That's not a premium. That's a completely different market pricing the same commodity at radically different levels, because one market is real, and one is manipulated illusion. And here's what made my hands shake when I plotted this data. The divergence is accelerating. The rate of gap expansion is increasing. 3 months ago, the gap was growing at about $3 per month. 2 months ago, $7 per month. Last month, $18. This month, we've already seen a $23 expansion in just 3 weeks. I flew to Hong Kong, and the story was identical with slight numerical variations. Physical silver dealers in Central and Kowloon were selling 1-ounce coins at $117, 10-ounce bars at $122 per ounce, 100-ounce bars at $114 per ounce with 4 to 6 week delivery delays. I met with Margaret Chen, who operates a precious metals brokerage serving wealthy Chinese families, and she explained the dynamic with remarkable clarity. "My clients don't look at COMEX prices," she said, while we sat in her office overlooking Victoria Harbor. "They know COMEX is Western banking manipulation to suppress prices and protect short positions. They look at physical availability and what it costs to actually acquire metal you can hold. Right now, that cost is between $110 and $130 depending on form and quantity. They're happy to pay these prices because they believe correctly, I think, that when COMEX finally breaks and admits it cannot deliver physical metal, prices will gap to $200 or $300 overnight. Paying $120 today to avoid paying $250 tomorrow is rational." The Singapore experience added another data point that confirmed the pattern. Physical dealers along Northbridge Road and in the Raffles Place Financial District were quoting prices between $108 and $125 per ounce for immediate delivery. One dealer, an Indian man named Ravi, who'd been in the business for 2 decades, told me something that crystallized the entire situation. "I have American customers who call me confused and angry," he explained, showing me messages on his phone. "They see COMEX at $71. They see my price at $115. They accuse me of price gouging, of running a scam. I tell them, go to COMEX, buy your silver at $71, take physical delivery. If you can actually do that, I'll match their price. But they can't. COMEX won't deliver at $71. They'll give you excuses, delays, force majeure notices, offers of cash settlement. The $71 price only exists on screens. The real price, the price at which physical metal changes hands, is what I'm quoting. That's not gouging. That's reality." I needed to understand why this divergence existed and why it was accelerating, so I spent 3 days interviewing everyone I could find with knowledge of how silver markets actually function. Dr. James Liu, an economist at the National University of Singapore who specializes in commodity markets, provided the framework I needed. "What you're witnessing is the endgame of a fractional reserve precious metals system," he told me during a video interview I recorded. COMEX and the London bullion banks have been operating like fractional reserve banks for decades, selling far more silver in paper form than exists in physical form, assuming that delivery demands would remain low, and they could manage any supply squeezes through price manipulation and contract rollovers. But something fundamental has changed in the last year. Asian industrial users and investors have lost confidence in paper markets and are demanding physical delivery. The banks cannot satisfy these delivery demands without buying physical metal at real market prices, which are far above the COMEX paper prices. So you get this divergence where paper trades at $71 and physical trades at $130. The gap represents the premium required to source actual metal in a market where supply is far more constrained than paper markets admit. The industrial demand side of this equation is fascinating and terrifying. I spoke with a procurement manager for a major Japanese electronics manufacturer who agreed to talk on condition of anonymity because his company doesn't want competitors to know they're struggling to source silver. "We use approximately 3 million ounces of silver annually in our manufacturing operations," he told me over coffee in a Tokyo business hotel. 6 months ago, we could secure supply through COMEX futures contracts at spot price plus small delivery premiums. Those contracts are now unreliable. We've had multiple delivery failures, delays, force majeure declarations, so we've shifted to sourcing physical silver directly from mines and refiners, and the prices we're paying have nothing to do with COMEX quotes. We're paying between $105 and $125 per ounce depending on delivery timelines. This adds enormous cost to our production, but we have no choice. Our manufacturing lines cannot stop because COMEX prices are make-believe and actual metal is unavailable at those prices. The graph showing global silver supply versus demand tells the story of why this divergence exists and why it's getting worse. World silver mine production in 2025 was approximately 830 million ounces. Global silver demand, combining industrial use, investment demand, jewelry, and photography, totaled approximately 1,100,000,000 ounces. That's a 270 million ounce annual deficit. For years, this deficit was filled by above-ground stocks, recycling, and sales from government stockpiles. But above-ground stocks are depleting. COMEX registered inventory has dropped from 112 million ounces 2 years ago to 19 million ounces today. London Silver Vault's inventory is down 68% over the same period. The physical metal that backed the paper trading system is being drained away by industrial demand and investment buying, and what remains is a paper market pretending that silver is plentiful and cheap, while the physical market knows the truth: silver is scarce and getting scarcer. I interviewed 4 different COMEX traders, people who make markets in silver futures, and to my surprise, 3 of them admitted off the record that they know the system is broken. One trader who's been in precious metals for 15 years told me over drinks in a New York bar, speaking carefully to avoid saying anything that could be traced back to him, "Everyone in this business knows that COMEX silver is a joke. We're trading paper that represents silver that mostly doesn't exist. The registered inventory is a fraction of open interest. If even 10% of contract holders demanded delivery, the entire system would collapse. We keep trading because the game hasn't ended yet, but we all know it will end. And when it does, the people holding physical metal will be wealthy beyond measure, and the people holding paper contracts will be left with worthless promises. Tokyo is paying 130 because Tokyo knows the game is ending." What shocked me most during this investigation wasn't the price divergence itself, though that's spectacular enough. What shocked me was the casualness with which Asian market participants discussed the collapse of COMEX credibility. In Western financial media, COMEX is still treated as the authoritative price discovery mechanism for silver. Bloomberg, Reuters, financial websites all quote COMEX spot prices as if they represent real market value. But in Tokyo, Hong Kong, Singapore, Mumbai, no serious participant in physical silver markets pays attention to COMEX anymore. They've moved on. They've established their own price discovery based on actual supply and demand for physical metal. The West is still pretending the paper market is real, while the East has already transitioned to a new paradigm. And that gap, that cognitive dissonance between Western paper prices and Eastern physical prices, represents an arbitrage opportunity for anyone who understands what's happening, but also represents a catastrophic risk for anyone who owns paper silver thinking they own real metal. The geopolitical implications of this divergence are staggering. I spoke with a former U.S. Treasury official who now works in private sector consulting, and his analysis was delivered with obvious concern about American financial dominance. If Asian physical markets become the new benchmark for silver pricing, and COMEX is relegated to irrelevance, that's a massive blow to American influence over global commodity markets, he explained during a call from Washington. Commodity pricing in dollars through American exchanges has been a pillar of financial hegemony for 70 years. If silver pricing shifts to Tokyo, Hong Kong, and Shanghai based on physical transactions in local currencies, that's a crack in the foundation. Other commodities could follow: oil, gold, agricultural products. We could be watching the beginning of a major shift in how global commodities are priced and traded, with American exchanges losing centrality. That has enormous implications for the dollar, for American financial power, for our ability to influence global markets. I returned to New York last week and immediately visited several physical silver dealers in Manhattan to see if the same divergence existed domestically. The results were illuminating and disturbing. Dealers were selling American Silver Eagles, 1-ounce coins produced by the U.S. Mint, for $97 each, Canadian Maple Leafs for $93, generic silver rounds for $89. These aren't Tokyo prices, but they're nowhere near the $71 COMEX quote either. When I asked dealers about the premium, every single one gave me the same answer. That's what it costs to get physical silver right now. COMEX price is for paper contracts. If you want actual metal, this is the price. One dealer showed me his supplier invoices proving he was paying $82 per ounce wholesale from his distributor. He's selling retail at $89 with a $7 margin. There's no gouging happening. The entire supply chain, from refiners to distributors to dealers, is operating at prices 40 to 60% above COMEX, because that's what physical silver actually costs when you need to deliver real metal rather than paper promises. The math is simple and damning. If you can buy silver at $71 on COMEX, take delivery, and sell it in Tokyo for $130, that's a $59 arbitrage profit per ounce. At scale, that's phenomenal returns. So why isn't everyone doing this? Because you can't actually buy silver at 71 and take delivery. The COMEX system doesn't work that way for anyone but the largest institutions, and even they are facing delivery delays and failures. The $71 price only exists for paper trading. The moment you demand physical metal, you enter a different market with different prices. The illusion is that COMEX represents real silver pricing. The reality is that COMEX represents paper contract pricing in a system where the paper vastly exceeds the physical backing. And that gap between illusion and reality is now $59 and growing. What keeps me awake at night after this investigation is the certainty that this divergence cannot continue indefinitely. Markets don't sustain 83% price gaps for the same commodity unless something is fundamentally broken. Eventually, one of three things happens. COMEX prices rise to meet physical market prices fall to meet COMEX prices, or COMEX becomes irrelevant and ceases to function as a price discovery mechanism. Given supply and demand fundamentals, given the ongoing drain of physical inventory, given the loss of Asian confidence in Western paper markets, I cannot construct a scenario where physical prices fall. The only logical outcomes are COMEX prices rising dramatically or COMEX losing relevance entirely. Either way, anyone who owns paper silver at 71 thinking they own something valuable is going to face a reckoning when they try to convert that paper into physical metal and discover the conversion is not possible at anywhere near the price they thought they were paying. The conclusion I've reached after traveling across Asia, interviewing dozens of market participants, analyzing hundreds of transactions, and plotting mountains of data, is both simple and revolutionary. The silver market has already split into two completely separate markets that happen to share the same name but operate in different realities. The paper market, dominated by COMEX and still referenced by Western financial media, trades at $71 based on contracts that mostly represent silver that doesn't exist or isn't available for delivery. The physical market, increasingly dominated by Asian buyers and sellers, trades at $100 to $130 based on actual metal that can be verified, delivered, and held. Western investors looking at screens think silver is cheap. Eastern investors holding metal know silver is scarce. And the gap between these two perceptions is measured in tens of billions of dollars of wealth that will be transferred from those who discover too late that they own paper to those who understood early that only physical metal has real value. The ending I want you to understand from this is not panic, though the information certainly justifies urgent action. The ending I want you to understand is that price is information, and right now, different markets are providing radically different information about the same commodity. Tokyo is telling you that silver is worth $130, and supply is constrained. New York is telling you that silver is worth $71, and everything is fine. One of these markets is dealing in reality, and one is dealing in illusion. Your job as an investor, as someone who wants to protect and grow wealth, is to figure out which market is telling the truth and position accordingly before the truth becomes obvious to everyone and the opportunity to act has passed. I saw the prices with my own eyes, I verified the transactions, I interviewed the participants. Tokyo is paying $130 for the same metal. New York claims is worth $71. That gap is not an anomaly. It's not temporary. It's a signal that the entire precious metals pricing system is breaking down, and when it finally breaks completely, the people who understood the signal will profit enormously, while those who trusted the illusion will learn an expensive lesson about the difference between paper and physical, between promises and reality, between what screens say and what markets do. Consider yourself warned, consider yourself informed, and ask yourself, if you needed to buy 1,000 ounces of physical silver tomorrow, not contracts but actual metal, what price would you actually pay? Because I promise you, it won't be anywhere close to $71. It'll be closer to $130. And that tells you everything you need to know about which price is real and which price is illusion. The Tokyo shock is that physical markets have already moved on from Western paper prices. The New York illusion is that those paper prices still matter. Reality always wins eventually. The only question is whether you're positioned for reality or still believing in illusion. Choose wisely. Time is running out. Time is,